Hello everyone, this is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms. Like you see here with our 21 SPY and ES mean reversion systems, and of course our exclusive KISS trend following systems. Nothing like it on the internet. Really excited about that. Anyway, it's the weekend. It is September 10th. It is Sunday evening. So this is going to be our extensive weekend newsletter again for September 10th, 2023. If you happen to be new to Breakpoint Trades, these weekend newsletters tend to be quite comprehensive, anywhere from 40 minutes to close to an hour. We cover a lot of things, so be prepared to, sit through quite a bit of analysis. Again, the way the markets work, trading works, pick the information that suits you, but we cover pretty much all the aspects. Anyway, let's go ahead and get this started. This is our back-end recorder for the standard newsletter website, so I'm going to go ahead and get this started. Hello everyone, this is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone has had a wonderful weekend. It is Sunday, September 10th, 5:30 Central Standard Time, and this is, again, the weekend newsletter. As you can see via the table of contents at the top, the newsletter is divided into 6 major sections, the same general theme as we always keep. We do some opening discussion, brief market commentary, looking at last week's performance. We're also going to do a deep dive on the KISS systems. I already discussed some of this last week, but I'm going to show you some statistics for those of you who haven't seen that. And again, if you haven't done so, especially if you're a subscriber, set up your email notification for the KISS system tables. Again, you have to be a subscriber. You can't set up email notifications if you're not a subscriber. All right. And then we'll move to the general market analysis. For the weekend, we do a general top-down approach. We look at the bigger picture charts, monthly, weekly, daily, intraday timeframes. We'll also look at some custom indicators and, of course, bonds and the 10-year treasury yield. We'll look at the major sectors. We generally do a broad overview. Then we're going to follow up with the US dollar, commodities, precious metals, GDX, gold miner stocks. All right, guys. So a couple things. As you know, last week, the market basically opened right at resistance. A couple weeks ago, the market was very oversold. It was due for an oversold rally, and we got that. It stalled at resistance essentially last Monday. The S&P retested a broken trend line, channel trend line, and that's where it logically pulled back from. Again, so far, the market's played out pretty much as we've been stating for many months. We expected the market to rally, hold up throughout the summer, which it did. We expected a pullback in August and September, and so far that's been the case. August was quite weak, and we expect a little bit more weakness here in September. So far, seasonality's been playing out. News items this week, the big ones are the CPI and PPI inflation data. Those could be important news catalyst for the charts this week. Again, short term, like I said, we were quite oversold a couple weeks ago. We stalled at resistance, pulled back last week. One thing we're leaning towards slightly here is that we did get a slight bullish break in symmetry on that rally from the previous week's low. And we also had a break in structure. So what we mean by that is a symmetry break, the largest bounce occurred since the downtrend from the July 27th highs. We also took out a prior high. Remember, the markets, when they're downtrending, they form lower lows, lower highs. We took out the previous lower high. So that action causes us to favor maybe some more upside here in the short term, maybe to complete possibly some sort of wave C or maybe a coil, and then maybe come down again. Usually the markets holds up in the first part of September, and then it weakens the last part of mid-September onward into October. So we'll see if that seasonality plays out. Okay. Next, item number 2. So I'm going to discuss this chart below in the intraday charts, but again, I just show it first to show so that you can see what we're looking at short term. So this is a 10-minute view of the S&P. Steve posted this on our trading community blog on Friday afternoon. So again, the market, as you know, it topped out in late July, and this is a potential wave structure we had marked. The rally from the September 7th low to the September 8th high is the largest bounce in the downtrend. We also took out that previous, we had a structure break as well, meaning we took out the previous higher low there. So along with the symmetry break and the break in structure, at the moment we're favoring a higher low here short term, like we see maybe some sort of ABC up, WXY. There's also an open gap here from the morning of September 6th, which could be a magnet, so we favors maybe something like this, maybe even up to this gap, and then pull back again to make another low to complete the pattern. The other thing that could happen is some sort of coil action. Again, we'll react to whatever the market does, but that's what we're favoring at the moment. Next. Item number 3 shows the index sector table, what transpired last week. So for the major indexes, again, Friday was just a slight up day, mostly for the indexes, except for the small caps. Russell for the week, nice pullback. Dow down only 0.75%. Dow down about 1 point. S&P down 1.3%. NASDAQ down anywhere from 1.4 to 1.9%. Russell 2000 really taking it on the chin, down 3.6%. As far as the major market sectors here, we follow 21 of them, and most of them were down. Okay, as you can see, the exceptions: energy finally bounced. Remember, they've been strong, and drugs and utilities were slightly up. Currencies: U.S. dollar, nice week once again, up 0.9%. That is, of course, not helped the precious metals area. Now the gold and everything is holding up fairly well. It's only 100 points off the highs essentially from the late April to early May highs, but that puts stress on that. And cryptocurrencies were mostly down for the week. Commodities for the week, kind of a mixed bag here. The DBC, that's the index, was up mainly because of crude oil, which gained at 2.3%. Remember, there's also some, the Saudis going to continue cutting production. They're being supported, of course, by Russia. And, of course, again, I don't like to get political here, but like I said, the Biden administration, as you know, they sold their strategic oil reserves about a year ago during midterms to help the elections. Probably only made a 5 or 10 cent difference at the pump. And they never reestablished, never refilled those strategic oil reserves, which is asinine to me. They should have done it back in April, May, June, when crude oil, was 30, 40 points lower. Just unbelievable. And of course, you don't announce it to the world. So just, to me, it's utter incompetency, but hey, it is what it is. Other commodities, though, were down. Natural gas, pretty good pullback, down 5.8%. Copper down 3.5%. That could possibly be foreseeing some future weakness, that future recession that economists are thinking we might not get. Well, that's down pretty good. That, of course, is also affected by the rising dollar. The ag sector was strong mostly. Coffee was down. Now, what was weak, like I said, precious metals. Look at gold here. Gold down 1.1% for the week. Silver down 5.25%. Platinum, palladium down pretty big. And GDX, the miners, down 2.6%. They're underperforming. As far as bonds, high yield corporate down for the week, TLT down, 10-year, 30-year yields up. Again, these yields are very important for the market, so we'll see. For the market to have some sort of good end-of-year rally, we need to see rates stabilize, pull back. If they were to break out, that would not be good. I have some scenarios I'll show you when we get to the bond area. Next. Item number 4 shows the economic news calendar. Again, a couple obvious items are CPI, so that's on the 13th, see, Wednesday, and then you have the PPI on Thursday. So those are the obvious ones to watch next week. Potential market movers, obviously, as they represent inflation. Okay, let's move on. Now, before we get into the index analysis, let's talk about our KISS trend systems. And again, guys, KISS trend systems are a proprietary trend following system that I developed a couple years ago. I developed them initially for the major indexes, and then this year we expanded them to a bunch of individual stocks, etc. It's a system that is a trend following, it's long only, and it gets into a position as the index or stock moves higher, it will raise a stop up over time, kind of like a trailing stop. We call it smart trailing stop. So it gives you a protection. And they're non-curve fit, and they're virtually profitable on almost anything. So a pretty universal system. Nothing out there like it. Again, these are some of the things I discussed last week. So here's an example of the Q's daily KISS system versus the Q's if you simply bought and held like the majority of, say, financial advisors or the public does. Okay, so I have the years here going back to 2004. As you can see by the columns, you have percent gain for that year, profit factor, number of trades, percent profitable, max drawdown for the trade entry for the KISS. On the right here, we have the simple buy and hold, and of course the max drawdown from the highs, and some comparisons to the KISS. And if you look at the stats here, it's just pretty phenomenal. I don't know why anyone would trade the index anywhere else, especially if they're holding longer term positions for 401k. So, for example, 2023 KISS system would be up a little less than the market, right? But you can see the drawdown only 2.5% versus about 9% for buy and hold. Again, the year's not done. This percent gain could, by the end, beat the actual buy and hold. Now, 2022, the KISS system destroyed buy and hold. KISS system for the triple Qs daily lost 8.7%. There were 5 trades at a max drawdown of 4.4%. That's the max drawdown, guys. Look at the Qs buy and hold. Lost 33%. So contrast that to the KISS system that lost 8.7%. Which one would you rather do? Also, what really stands out is the max drawdown. 4.4% for the KISS system, 36.5% for the buy and hold. I mean, that is a hell of a difference. To me, instead of total returns, my biggest thing, because I'm very risk averse, is the drawdown. I don't like going through drawdowns like that. So that's impressive. 2020, for example, KISS daily Qs made 71.7%. 4 trades, 100% winners, a max drawdown of 4.1%. That's it. What about Qs buy and hold? Well, they made 47.5%. That's still an excellent year, right? KISS system blew that away, though, made 71.7%. But the max drawdown, again, that's the big takeaway from these. By the way, these boxes I'm showing where the max drawdown was high for buy and hold, and you could compare the KISS. But the max drawdown in 2020 was almost 30.5%. So again, even if the KISS made the same gains as buy and hold, or even a little less, which one would you have rather done? Held through the 30.5% drawdown or only a 4.1% drawdown? Again, most years of the KISS actually beat buy and hold if you look at this. Not all the years, all right? But most of the years collectively do, and especially bear years, obviously, like 2022. Look at 2008. KISS system made 9.5% in that horrible bear market year. The max drawdown, 4.2% for 2008. That's ridiculous. Max drawdown, 51.5% for buy and hold. The year total was 42% down. KISS system made 9.5%. Again, not every year is better, but most years are. And again, the max drawdown is always better. KISS system has, on average, a max drawdown of 5 to 6-fold less than buy and hold. To me, that's getting on to holy grail type territory. And I don't like to use that term, but that is pretty damn impressive. Next. Here's some other ones. Here's SPY, 195-minute KISS. That's a half day. And versus buy and hold. And then below here I have UPRO. And of course, you can look at the trade stats, it's essentially the same thing. Again, buying the KISS system beats buy and hold on most years. The max drawdown very low. The average max drawdown over all those years about 3.3% versus 14.3% for buy and hold. But again, it's the bear market years really make a difference. So, 2022 KISS system at a 5.7% max drawdown versus 28%. KISS system was almost flat for 2022 for SPY, where the buy and hold lost 18%. 2020 KISS system made 41%, max drawdown of 5.4%. Buy and hold made 18.4%, and of course max drawdown of 33%. That was the COVID sell-off. The KISS system avoided that big sell-off. Below here is UPRO. That's the triple ETF. Now, obviously being a triple ETF, the max drawdown goes up about 2 to 3 times, as you'd expect. So 9.1% average max drawdown. It's still less than buy and hold, right? But look at these gains. 105% gain for 2021, 30.9% gain 2023, 60.1% 2019, etc. So, and again, the number of trades per year are quite low. Even if you have a fairly restrictive 401k, you're talking maybe, an average of 3, 4, 5 trades a year, depending on things. That's not that many. Also, guys, before I get some more questions, I showed some of these statistics last week, and someone asked me, well, where are these on the website? They're not on the website at this time. I'm still, these half-day charts, I'm still developing them, still deciding what I'm going to do with them. But I'm simply showing you some things I'm working on and statistics, okay? I would like to put these out, but again, they're not on the website at the moment. The daily ones are on the website. Like I said, I just showed you the Qs daily above and etc. Remember, the KISS tables that we have on the website, we track the indexes and over 630 instruments. So if you want to check individual stocks such as Apple or Meta, you can do so. All right, guys, let's move back to the general market indexes. So image number 7, this is a yearly chart of the 5 key major indexes. So each candlestick is 1 year. Okay, I'm just going to show you where things look like so far for 2023. So this chart was updated as of September 10th. And you can see, again, as you know, last year, bear market year, big down candles, especially for the NASDAQ. So far this year, the Dow's up 4.3%, S&P up 16%, Triple Q's up 40.3%, IWM only up 6.2%, DBC and TLT, DBC led last year. It is lagging this year. Again, as the general market came back, it's up 1.7%. And TLT 20-year bonds down 3.2%. Next. Image number 8. Here's a monthly view of the major indexes. This goes back. You can see the 2009 lows, 2008 lows. But anyway, again, so far, seasonality has been playing out. First off, we've had a heck of a rally this year from the November lows of last year, the bear market low. And so far, August has been down per seasonality, which we expected. And so far, September's down a little bit as well. Again, we're not through with September. I think September could weaken quite a bit, especially later in the month. So we'll see. Next. Chart number 9, here's a weekly view of the major indexes. One thing I want to point out, again, you can see how, let's see. So again, we topped out in late July, which we expected. We pulled back in August. We've bounced here. So far, we got a lower high. One thing I'm keeping an eye on is maybe some sort of ABC. So we have a B here working perhaps, and then we work down in a C eventually, and that'll set a decent trade low for some sort of end-of-year rally, assuming nothing blows up in the system, obviously. But that's kind of what it looks like at the moment. Kind of has this, potential zigzag, and then I would expect a decent end-of-year rally. The other thing you could do is form some sort of coil. Right? Let me clear that out. Some sort of coil that would, give this time and then bust out. So those are a couple options we're monitoring. Next. Chart number 10, here's the daily view of the 5 key major indexes. Again, a couple weeks ago, we were below the lower Bollinger Bands. A lot of indicators were buried, like the McClellan oscillators, the NAMO, below the lower Bollinger Bands. We expected a rally up, and we got one a couple weeks ago. It topped out last Monday, and we've pulled back. So far, we got a higher low in place at the moment. Next. Shifting to the individual indexes, chart number 11, here's the Dow. Again, the Dow, I showed this potential inverse head and shoulder pattern back in May, which mostly played out. We had a nice healthy correction in August. We held the uptrend line for now. The rallies for now stalled at the 61.8 fib as expected. So far, we got a little lower high here. We'll see what happens this week. I had a little downtrend line here to monitor, and of course this uptrend line. Next, moving on to the S&P 500, chart number 12. Here's the weekly view of the S&P, down 1.3%. So again, hell of a rally from that October low last year. As you know, it rallied all the way to the top of this channel and this supply zone. It topped out there on July 27th. Perfect technical analysis. Again, hit 2 areas of resistance, and you had seasonality. And so we got a nice sell-off in August. We got a little bounce so far in early September. By the way seasonality has worked, usually you got weakness in August and September. A lot of times the first part of September is up, the first 10 or 15 days, and then the last part of the September, last half of the month is down. And so that's been playing out. Market's been up a little bit here early September. Now we'll see if, once we approach mid-December and later, we get a pullback. There's a demand zone down in here. Another target could be this lower channel, lower 4200 area. To me, that would be a good area for a buy signal. The other thing to monitor long term is this trend line on the RSI 14. Have never lost that. Next. Chart number 13, here's a zoomed in daily view of the S&P. And again, as I stated in the open comments, again, we topped out in late July at the top of this channel, right? We had divergence there, seasonality, everything called for a pullback, and we got that nicely into August. We bounced off this demand zone, and last Monday, the previous week we were up. Last Monday, we stalled at the retest of the broken channel, which we expected. And we pulled back. So far, we bounced off a little demand zone. Now we'll see if we can get a little more upside this week or not. Next. Chart number 14. Here's another chart showing potential wave counts. Again, the thing we've been favoring mostly is some sort of wave 4 pullback, which again could be over, or wave 4 could be completed sometime in later September. If we hold this channel, that's what we've been favoring. Next. Chart number 15, here's another daily chart of the S&P, zoomed out version. Again, shows the similar view as the first S&P daily. We topped out in late July. By the way, we had a great RSI trendline sell signal there. First day of August, played out beautifully. We got down near this big support zone in the low 4300s. You can see that's been important resistance and support for the last year. We stalled at this broken trend line. And what remains to be seen if we sell off down here, retest this, or get down to the lower, like I said, lower 4200 area for the bigger channel on the weekly. I would not mind seeing that. I think that would be a good buy opportunity. Next. Chart number 16, here's the daily KISS trend system for the S&P. Again, the KISS system for the S&P went long there in late March. It exited in early August, had a winning trade. It has been flat since. It's waiting for its next entry. Next. Chart number 17, here's the 4 time frames with some of our custom indicators, the dailies at the upper left. Again, a couple weeks ago, we were very oversold. Like I said, we had DeMark 13 on the daily, DeMark 913s on the half day and 130-minute chart, and we bounced up. Okay, so far in the daily, we're still above the ATR. On the half day, last Monday, we had the A's here. That's amateur buying. They tend to chase tops. And we had a cycle resistance here. That's the cyan dots. Nice logical pullback. So far, we're holding the ATR. We had a little support cycle here. That's a positive. Maybe we can push up. The 130-minute, we had DeMark 9 and 13 trying to hold that. Next. Chart 18, here's the half-day chart of the S&P. Again, we pulled back last week. We did bounce off this demand zone for now. Moving average ribbon is pension bullishly stacked. Next. Chart 19, here's a 30-minute chart showing some different wave counts. Possible little short-term for stuff. We counted 5 waves up the previous week, and we pulled back from there. We have a potential little 5 waves here, or it's possible we could get another low here as a 5. Again, we'll know early this week. Next. Chart 20, here's a 15-minute view. Hardly any indicators on here. One thing to point out is just from the September high here, we had a little break in symmetry and structure here because we took out this previous high. That gives us a little hope that we could perhaps push up higher here first before we get our next sell-off. Finally, chart 21, here's the 10-minute chart that I showed the first part of the newsletter, these wave counts. Again, because we had a little structure break here and symmetry break, it is possible. One thing we're on the lookout for is maybe an ABC move up for C, maybe even up to fill this gap, and then down in later September to another low. So those are the options we're favoring. Again, or some sort of coil action, like I already discussed. Next, chart 22, here's the triple Qs. Again, as you know, a couple weeks ago, broke this little steep downtrend line, back tested it as support. Rally up so far. This is your demand zone to monitor. Moving average ribbons bullishly stacked at the moment. Next. Chart 23, here's another triple Qs daily. Last Monday, we also back tested this broken trend line, found resistance there. Okay. Otherwise, on the Qs, long-term symmetry has not been broken. Since the October lows, the largest pullback in the uptrend is 36 points. That pullback off the highs so far only about 33.3 points. But again, last week we stalled at the broken trend line here. Next. Chart 24, here's the KISS trend system. Again, the KISS trend system for the triple Qs went long there in early March, exited in early August for a nice winner. It did go long here again about a week and a half ago. So far, it has a wide stop here at the low there. We have the ATR support. Again, this remains to be seen if this ends up being a good trade or a whipsaw. Sometimes after a nice winning trade like this, these trending systems sometimes will get a good winning trade, and then they get a whipsaw, and then they get a winning trade. A lot of times you don't get a lot of back-to-back winning trades. Just the nature of how trend works. Next. Chart 25, here's the 4 time frames we like to follow. The daily upper left. Again, last Monday, we had to mark 9 and A, so that was a logical area to pull back from. The previous week, we had to mark 13, very oversold. We bounced from that. We're above the ATR on the daily and half day. You could see last week, we also had a resistance cycle in 130-minute, just like on the S&P, pulled back from there. And we're still above the ATR here. We're below the ATR on the smaller time frames, 130-minute and 78-minute. Next. Chart 26, here's a 30-minute view of the Qs. Still holding this parallel channel line. We basically tested that on Friday. Now we'll see if we can bounce. The dotted lines here represent symmetry. We did get a little symmetry break here on this rally, so we'll see if we get if this ends up forming a higher low. If not, there's a demand zone down here if we break this channel and take out the recent low of 369.15. Next. Chart 27, IWM small caps. Again, they were the weakest last week. They were down 3.6%. Remember, contrast that versus 1.3% for the S&P and 1.4% for the Qs. So quite a bit lower. Here's this coil, this triangle we've been showing since basically early this year. We bounced off the lower coil trend line there in March, which we favored, and in May was a good area to go long. We rallied all the way to the top of the pattern, pulling back. There's a little demand zone right here in the middle. We've been holding that for now. One option would be, the bearish option would be, we completed a wave E up there, and we're eventually going to go down in a C. But for now, we're still holding the pattern. Again, this was the weakest index last week. Next, chart 28. Here's the IWM daily. Shows you the same ascending type triangle. Again, nice sell-off from the upper trend line there. Hope you guys took profits there. It was a logical area to do so. You had 5 waves up. You're at the upper end of this trend line. And so far, IWM still holding its 200-day moving average. So that's something to watch. Here I also added fibs here to monitor. Someone asked me, does this look like the indexes kind of have a slanted head and shoulder here? And you can see this. The S&P has it as well. Let's see. But again, I'm not sure about that. I'm not really in love with slanted head and shoulders like that. But it is something to monitor if we were just to fall out of bed. Again, anything's possible in this market. Next, chart 28. Here's the day, another daily. Again, this actually shows you the little head and shoulder potential if you were to lose this lower trend line neckline. Next, chart 30. Here's IWM 30-minute. Early last week, we broke that steep uptrend channel. Pretty good sell-off since. All right, guys, that does it for the major indexes. As far as futures tonight, they are up about a point, so they're pretty flat. No big moves there yet. Let's move on. Let's look at some of these indicators. Chart 31, here's the VIX. So the VIX, as you know, the previous week was traded 3 consecutive days below its lower Bollinger Bands. That's extremely rare. Go pull up a chart of the VIX with the Bollinger Bands, and 3 days in a row almost never happened. So that was quite extreme. So once we, logical that you got to pull back from there. This when it closed back inside the bands, gave a VIX Bollinger Band sell signal. You can see the VIX Bollinger Bands buy signals recently that worked. But the VIX has also been building a base here for the last 2 months, as you can see. Next, chart 32. Here's a 15-minute chart of the VIX. Steve showed this on Thursday. There is an open gap down here to monitor, and that also could be potentially a magnet, especially if the market were to bounce early this week. Next, longer term, chart 33, here's the NASI summation index. And again, just want to show you guys, this isn't anything for timing or anything, but it really illustrates the narrow breadth we've had all year, and really for quite a while here. What got us really bearish on the market in late 2021 was the fact that the NASDAQ and market was making new highs, but this NASI was making a lower high, suggesting a few stocks were only leading the market. Well, obviously that played out in 2022, but the market, remember, bottomed in October last year, and it's had a heck of a rally up. But this indicator has been made yet another lower high, and it continues working lower. So that negative breadth continues. That is not sustainable longer term, and it is something to be aware of, guys. The average, there's basically 10 stocks in the NASDAQ that equate to 80-90% of the gains in the market, and the average stock isn't like this. So this what this displays. Next, chart 34. Here's the NYSI indicator system. This gave us a sell signal back in, late August, early July. And right now, monitoring it here, you can see the stochastic curl up here. To me, that's not a buy signal. Remember, the buy signal on this, it needs to take out a previous high of the candle. So the candle last week needed to take that out. It did not. And it needs to take out last week's candle. So it needs to do that for a buy signal. So it hasn't given a buy signal here yet. Overall, you can see the previous trade. It's been pretty good. Chart 35, here's the NYSI daily with the 9 EMA. It's kind of a little system. You can see the S&P plotted below, and you can compare the buy and sell signals. Not perfect. These are never going to catch the highs and lows. Maybe 2/3 of the trend they'll catch, right? excellent sell signal there in early August, which played out. And so far, like you can see, it's not giving a buy signal. In fact, NYSI stalled at the 9 EMA there recently. Next, chart 36, here's the S&P 500 versus the bullish percent. One thing to note, there's divergence here, and this is potentially more bearish, a little short-term bearish on the market. The S&P so far is a higher high. The BPSPX has a lower high. So what I'm wondering here, and this BPSPX tends to lead. So if we were to get maybe, like I said, a little upside and then bust down into mid-September, just because of the way this looks, that's one possibility that I'm keeping an eye on. Next, chart 37, here's the BPSPX system. This has the 9 EMA and 20 SMA, basically a crossover system. You can see nice signals. Obviously, even though this bounced, these moving averages are far away from each other, have not given a buy signal. Okay, but again, there is this divergence showing up, as you can see, between the two. Next, moving on to bonds, chart 38, high yield corporate. Always important to track this. The market tends to follow high yield corporate, and you can see overall chopping around. And overall, it's holding up better than the general market. Still above its 50-day moving average here. Next, chart 39, here's TLT 20-year bonds. So far, we got a higher low in here. Also, notice your MACD KISS stochastic oversold. That's actually was a buy signal right here. But the odds are favoring a higher low here because of a bullish symmetry break. So TLT topped out basically in April, March, and the largest bounces in the downtrend was about 4.2. Well, the rally off the low here, 4.8, so that told us to look for a higher low. If TLT can go up, that would force the 10-year to go down, and that would help the market. Next, chart 40, here's a 60-minute view of TLT. So we had a falling wedge there into later August, which played out, and then a little rising wedge. One possibility could be an inverse head and shoulder here. You can see price did bounce off this parallel channel or neckline. So let's keep an eye on this. Chart 41, here's TLT on the monthly. Now, even if TLT manages to bounce here in the short term, one thing I do think TLT eventually will probably work down into this demand zone. You can see the demand zone from 2013, early 2014. And also notice this would set a 5-wave downtrend and you'd have MACD divergence. That, especially if this were to happen over the next few weeks, that would allow the market to have another pullback and then bottom. Because here's what I think it would do. It would get into this 5th wave area. Then it would form a decent trade low. Then you would have an A, B, C up. That would allow for an end of year rally, stuff like that. But the fact that you'd have 5 waves down, that would confirm longer term that TLT is in a bear market. Okay. Next, chart 42, here's the 10-year treasury yield. Weekly view, again, as you know, it's been bumping up against this resistance. I think over time it will break through here, but for now it's been pausing. Next, chart 43, here's the daily. Again, so far it's been pausing at this area, but again, the scary thing is this kind of has a cup and handle look longer term, doesn't it? Finally, chart 44, here's a monthly view going back to the early 1980s. Again, we broke out of the channel early last year. That sets the stage. We've rallied up to this area. Over time, I do think the 10-year could even work its way up to this lower 5% area over time. That's the next major resistance. Finally, chart 45, here's the yield curve. Again, it is still negative. It has bounced back here off the lows. You did have an RSI positive divergence here. But, again, I know Goldman Sachs puts the odds of a recession at 15%. I still think a recession is ultimately inevitable. This yield curve has been negative for a long time, and I think it will play out. All right, guys, let's move on and look at sectors. So we're just going to we'll do a broad overview look of the individual sectors. So here's XLK Technology, still holding up fairly well here. We did have this pullback into August, did slightly exceed that pullback, the previous largest pullback. So you did have a slight symmetry break there. So far we have a slight lower high. Short-term support is the 20-day moving average here. Next, chart 47 here is semiconductors. Nice pullback as well. Longer term supports down here at 3250. Next, chart 48, here's the transports. Transports have been quite weak. We also showed this little rising bear flag, little wedge flag the previous week, and that obviously played out. 200-day moving average isn't too far away. Next, chart 49, financials, more just chopping around here. Bounced off around the 200-day moving average recently. Here I added a downtrend line to monitor, and of course that 200-day moving average. Next, chart 50, here's BKX, banks. They've been weaker than the financials. We did get a pop out of that coil, but, didn't go too far, and we've pulled back quite a bit. We're below the 20-day, the 50-day. Good things don't happen below the 50-day, guys. So really, it's a short term. You at least got to get above that 20. Next, chart 51, here's biotech. That's been quite weak. Last week, stalled at the downtrend channel line. Next, chart 52, real estate. Quite weak here as well. The last rally stalled at the underside of the 50-day moving average. It became resistance. So here it's come all the way back down. I added this little trend line to monitor. I know retail is dealing with a lot of this, they call shrinkage, theft essentially. And of course, these gangs of people that go in and steal everything, 30 teenagers or whoever, and you can't stop. You have woke DAs who don't prosecute anyone, etc. And again, I'm not trying to get political, but that's been the problem in the retail space. Next, chart 53, XLP, consumer staples, very weak as well. Remember, they broke their trend line in early August. Short term, we do have a little MACD and stochastic divergence here, but again, we are downtrending. We'll see if we can get a bounce or not. Next, chart 54, real estate. Nice sell-off on that rising wedge. Again, recent rally stalled at the underside of the 50-day moving average. Next, chart 55, here's home builders. Last rally stalled at this extended trend line. Right now, we're just around so far we're below the 50-day moving average. Be aware of that. If this were to sell off to a new low, it may want to test its 200-day moving average. It's been a while since we tested that. Next, chart 56, here's a weekly view of home builders. So again, home builders, quite honestly, this weekly chart doesn't look bearish, really. Kind of looks like a big cup and handle, maybe. But we got an initial move down, a B rally. Maybe we need a C wave down. Maybe that would test the 200-day moving average, and then you break out. We'll see. Again, the housing market still remains very resilient, not because of, obviously high interest rates hurt things, but really the main culprit there is just, no one wants to sell their house when everyone locked in 3% or less. Again, what would cause supply to increase on the market would be if the economy really weakens, people lose their jobs, and you get foreclosures. Okay. Next, chart 57, here's utilities. They've been weak, little bounce last week. We do have some MACD divergence here, though. Next, chart 58, here's the weekly version of XLU. Testing its 200-week moving average. Remember, that's always an important moving average. Next, chart 59, XLI, industrials. Again, we had a lower high here the previous week, pulling back. Again, if we lose that last low, 200-day moving average below would be a magnet. Next, chart 60, XLE. This has been a very strong sector. Fundamentally, it's come back quite nicely. Had a great year last year. It's lagged this year, but it's come back nicely since the June timeframe. We do have a new high here, though the candles here haven't been strong lately, kind of doji candlesticks. We do have some MACD divergence building. Next, chart 60, here's the weekly view. You can see this long-term uptrend that it's in, and trying to break out of this coil. Next, Charter 62, oil services. This is the weekly, up 1% for the week. Again, back in late July, we stalled at the upper portion of the supply zone, pulled back, then bounced up. We're at the very bottom of this thin zone, which I think we could fill over time. But short term, we have some divergence here. And quite honestly, I want to see a little consolidation here instead of just a melt up. Next, Charter 63, there's the daily. Again, it did break to a new high, bounced off this demand zone, but you have the MACD severely lagging here. You see that? And a bunch of dojis here, so little indecision candles. It's not closing at the highs. So to me, short term, it could be getting toppy here. Also, the other thing that suggests that is this chart number 64, the bullish percent energy index. Remember, this is a bullish percent chart. It can only go from 0 to 100%. It's based on point and figure charts. This is at 96%, guys, essentially. It can only go to 100%. That means almost all the stocks in the XLE oil services are on point and figure buy signals. It's like a contrarian. Okay, doesn't mean it can't go higher, but it's not the area where you buy swing trades. Where you buy swing trades is when this indicator gets oversold in this range, like it was back in June. You had actually a buy signal on our system here. Okay, now our system hasn't given a sell signal. It will when this closes below the 9 and 20 MAs. Okay, so that's what to watch. That's why I don't want to buy energy stocks for swings here. Again, I think they need a correction, and I'll look to buy them again afterwards. Next, moving on to commodities, Charter 65 DBC, that's the index, up 0.7%. Again, rallied logically off that 200-week moving average earlier this year, May, June, etc. Next, Charter 66, here's the monthly view of DBC. Again, to me, this looks like just a long-term bullish pullback in a bull market. You had a heck of a rally from the 2020 lows, got extended, moving average ribbon got very wide there, you can see. And you've had three-wave pullback, ABC, MACD is still above 0. Moving average ribbon was pinching on a bullish configuration. I mean, to me, this looks good. That also doesn't bode well for inflation or Powell. Next, Charter 67, here's the daily view. Again, you had a falling wedge, which we broke out of in July, rallied up, pulled back, found support at the 200-day moving average, and made a new high. Next, Charter 68, crude oil, weekly view, up 2.3%. Crude oil is now 87.5%. Again, Biden administration sort of replenished the strategic oil supplies in March, April, May, June, whatever, when it was much lower. They should not have advertised it. Again, even if you're extremely green and you want everyone to have electric cars, guys, ultimately we still need those strategic oil reserves. We're not set up, not to run. Okay, that's for emergencies. All right. Next, Charter 69. Here's the daily view. Again, I talked about this 200-day moving average being important. We regained this in July. That was bullish. We had a nice move up, pulled back. We held the 200-day moving average, and we popped it nicely. In fact, this still looks bullish. That's another reason why energy stocks are holding up here, despite the BP and the R being elevated. You can see that last pinch, moving average ribbon pinch, was a good buy opportunity. At the moment, looks kind of like a bull flag here. Next. Charter 70, here's natural gas. As you know, it's been basing here for essentially 2, 3, 4, 5, 6, 7 months. If it eventually can break out of this base, I think it would be a heck of a swing. Next, Charter 71, here's copper, weekly view, down 3.5%. It's got this big coil, hasn't broken the pattern yet, but this gives me some recession concerns, especially if this breaks down. Copper's used in everything. Next, Charter 72, there's copper on the daily. Remember, last rally stalled at the 200-day moving average near the downtrend line. Next, Charter 73, here's DBA, agriculture, up slightly for the week. Again, still holding this long-term uptrend. Next, Jabber 74, URA, uranium ETF. Remember, I'd been bullish on uranium for the last couple of years. And back in July, August, it looked like it wanted to break out again, which it has. Still looks very good. Jabber 75, here's uranium on the monthly. Again, if you need to pause the audio or video, just look at this, guys. We broke out of this nice base back in 2020. Initial move up in the bull market. Moving average ribbon got extended. We've had a year and a half long coil forming. Moving average ribbon came to pinch. The RSI held the 50% area. Again, to me, longer term, this looks really good. Next, Jabber 76, coffee. Haven't showed this in a while. It's had a heck of a correction since the 2022 highs, though I'm sure Starbucks hasn't dropped the price of their lattes. They're probably still $6 or $7. Anyway, there is a big support zone around the $1.40 range. We'll see if that can hold or not. Next, Jabber 77, here's Bitcoin. Bitcoin, as you know, busted down a little while back. Mostly been going sideways. Last week, the bounce stalled at the broken wedge trend line, to be expected. Next, Jabber 78, US dollar, weekly view up 0.84%. Beautiful rally off that 200-week moving average. Remember, that's always your important long-term moving average, and you had a demand zone there. And we'll see, guys, if this dollar continues rallying up. So far, again, all these fiat currencies and the dollar has these problems. It's still considered kind of the best flea on the dog. Still a flea, but maybe the best one on the dog. Next, Jabber 79, here's the daily. Again, heck of a rally since the July lows. We broke this little downtrend line, back tested it, held it. You have a demand or a supply zone up here, which could be a magnet over time. Next, Jabber 80, here's the Japanese yen. Haven't shown this in a while. So back last year, it retested the lows going back to 1998. That was the Asian crisis. Bounced off of there. This area became resistance. It's now all the way back to that area. Next, Jabber 81, here's Japanese yen on the daily. There is a potential wedge here to monitor. See if this can produce a bounce or not. All right, guys, let's now move to precious metals. Jabber 82, gold down 1.25% for the week. Again, it topped out there in late April, early May, up at this resistance with a wedge here. Seasonality, gold tends to be weak during the first part of the summer, and that obviously played out so far. Again, but it is held up fairly well. I mean, gold is up just a little over 100 points from the highs. That's not very much. One thing to watch is the ratio here, the GDX-GLD. Again, gold stocks need to outperform gold, so you want to see this ratio break this trend line ultimately. And another trigger could be the RSI 14 breaking the trend line. Next, Jabber 83, here's another weekly view of gold. Just a nice clean view. Showed you how we stalled at the upper trend line there. It's been 3 times now. Here, we could be working on some sort of long-term ABC. I do think, though, guys, again, longer term, I think gold's eventually going to bust out of this pattern in a big way. But right now, we're in a consolidation phase. Next, Jabber 84, here's the daily chart. Again, you can see the top, how we topped out there in late April with this wedge. Here, I added a couple trend lines to monitor, kind of a coil. You have the 200-day moving average. Monitor the GDX-GLD trend line. Next, Jabber 85, silver. This is the weekly chart, down 5.65%. So heck of a sell-off. You could see a potential big coil forming. Next, Jabber 86, there's the daily version. Got a nice pullback from the upper trend line there. It's still overall in this pattern. Next, Jabber 87, ZSL. That's the Ultra Inverse ETF for silver. We showed this trend line as a trigger, and that gave you a nice trade if you took it from that 17.5 area. Next, let's look at gold miners. So here's GDX, weekly chart, down 2.6%. So the gold stocks continue to underperform The metal, not good. Here we show a potential inverse or a head and shoulder pattern, but again, we'll see how this does. I also added a lower trend line here to monitor. But clearly, the onus is on the bulls, or let's say the onus is on the gold bugs. Next, chart 89, here's a daily chart just showing a clean channel. We bounced off this little demand zone a couple weeks ago. Stalled at the 50-day moving average, pulling back. So far, we got a higher low for now. Next, chart 90, here's BPGDM. That's the bullish percent gold miners index. So it's down here now at 14.3%. So it's getting quite oversold. Back in April, it was up at over 75%. Then we got a sell signal there. That was a good sell signal. We had a quick little buy signal here in July, and then it gave a sell signal in August. This is one to watch too. When this crosses up, that could be used as a trigger. Let's take a look at some individual names in this area in case this area does bottom sometime. Chart 91, here's SVM. It's a silver stock. You have a potential falling wedge here, MACD divergence. So I love these wedge patterns. Here you could draw a trend line on the ratio as well. So one to monitor. Cheap stock as well. It's a silver stock. Chart 92, here's Newmont. That's the largest, or has the largest weighting in the GDX ETF. It did bounce off this lower wedge trend line, but so far it's been kind of a muted move. But you always want to watch Newmont because it has the biggest effect on GDX. Next. Chart 93, here's KGC. It's another one. It's been kind of chopping around here. It's still holding this 200-day moving average. It's pulled back nicely in the pattern. Next, chart 94, let's look at Apple. So Apple, I think this week they launched their iPhone 15. Maybe that'll produce a little bounce. Again, we are favoring a little bounce up in the market early this week. So we did have a bearish break in symmetry in August. So I was looking for that initial sell-off in August to form a lower high, which we got. Again, whether we can go straight down or this needs a complex type of correction, coil, whatever, remains to be seen. Next, chart 95, here's Amazon. It's still holding up very well. One of the FANG stocks that's really holding up. By the way, the KISS system is still long this. 50-day moving average is your real critical support here, as well as the down trend line is your resistance. Chart 96, Walmart. We had this in the long idea last week. Started to break out a little bit. Next, chart 97, Procter & Gamble. Little potential coil forming here, one to monitor. And finally, chart 98, here's FDX. Potential short if it loses this support area. And I didn't look for any other ideas, guys. I may look for some and post them on the trading community later this evening. But anyway, wanted to get this newsletter out to you. Have a wonderful rest of your Sunday afternoon, and we'll see what happens this week. Take care, and thanks for all your support.